Welcome to This Explainer. Today, we're unpacking a massive, highly interconnected web, India's automotive tax system. If you've ever wondered why cars cost what they do, or how billions of dollars flow through the auto sector without getting totally bogged down in red tape, well, you're in the right place. We're going to look right under the hood to see how the Central Goods and Services Tax Act of 2017 and the Income Tax Act of 1961 collide in the real world.
So here's the multi-billion-dollar question for you. How exactly do you tax an industry of this massive scale without completely crashing its supply chain? The reality is, keeping the intricate gears of GST, input tax credit, and tax deducted at source perfectly aligned is a lot like tuning a high-performance engine. If the timing is even slightly off, you get extreme working capital friction, devastating double taxation, and a supply chain that just grinds to an absolute halt.
Okay, let's dive into this. Here is our roadmap for today. First, the auto tax architecture. Then, GST, ICE versus EVs. Next, ITC and demo car rules. After that, taxing warranties and repairs. And finally, the TDS and TCS hierarchy.
All right, Section 1. The auto tax architecture, laying the groundwork.
Before we track a single car's journey, we really need to understand how the indirect and direct tax regimes in India overlap. The first thing you've got to know is that tax liability in the automotive sector isn't just about the price tag. It's hypersensitive to incredibly specific physical criteria. We're talking about things like the exact length of the car, engine displacement, ground clearance, even whether it uses a battery or liquid fuel. These physical engineering specs bridge the worlds of indirect tax like GST and direct tax like TDS and TCS. Actually, it explains why you sometimes see cars designed to weird, extremely specific, and kind of awkward dimensions. They're literally just shaving off millimeters to dodge a higher tax bracket. These rules establish exactly how much revenue goes to the government at every single step of the value chain.
Moving on to Section 2. GST, ICE versus EVs, the showroom floor.
Let's step onto that showroom floor. The landscape changed radically with the September 2025 restructure, creating a massive divide between how internal combustion engine vehicles and electric vehicles are treated. What's really interesting here is the total elimination of the incredibly complex compensation cess. Traditional cars used to face a base GST of 28%, plus a variable cess based on luxury status and carbon footprint. A small petrol car had a 1% cess, but an SUV with over 170 millimeters of ground clearance faced a punishing 22% cess, pushing its total tax to 50%. Post-reform, this was brilliantly simplified. The cess is completely gone. Small cars are now grouped into a unified 18% GST slab, while mid-size cars and SUVs are consolidated into a top-tier 40% GST slab. Much cleaner, right?
But when we look at electric vehicles, things get a bit weird. To promote clean energy, a complete, fully assembled EV enjoys a highly concessional 5% GST rate. Amazing for the consumer for sure. However, the supply chain law has a glaring contradiction. If you buy a standalone lithium-ion battery or pay for charging services at a public station, you're hit with an 18% GST rate. It's wonderfully ironic. The government is aggressively incentivizing green energy while simultaneously turning it into a cash flow nightmare for the charging networks. For fleet operators and battery-as-a-service providers, well, they're earning revenue taxed at 5% but spending on their major inputs at 18%. This creates an inverted tax structure, forcing these companies to constantly file for periodic tax refunds just to keep their businesses afloat.
And what about used cars? The secondary market relies on something called the margin scheme. When a registered dealer resells a used vehicle, they don't pay GST on the full sticker price. They only pay tax strictly on their gross profit margin, so the selling price minus the purchase price. The rate is 12% for small cars and EVs and 18% for luxury models. And the best part? If the dealer takes a loss and the profit margin is negative, the tax is completely dropped. Oh, and if you're just selling your old car privately to your neighbor, that remains entirely outside the scope of GST altogether, which is a really nice relief for everyday transactions.
Okay, Section 3. ITC and demo car rules, inside the dealership.
Let's move behind the scenes into dealership operations to look at the historical headache of input tax credits, particularly when it comes to demonstration vehicles. By default, Section 17(5)(a) of the CGST Act strictly blocks input tax credits on passenger motor vehicles. If a corporation buys a fleet of cars for its executives, they cannot claim that tax back, period. However, to keep the supply chain moving, the law provides statutory exceptions.
Businesses can avoid paying unrecoverable tax costs if the vehicles are used for commercial passenger transport, driving instruction, hauling freight, or, crucially, for further supply, which basically means acquiring a vehicle specifically to resell it.
For years, tax authorities argued that dealership test drive cars, demo cars, were for marketing, not resale, and they aggressively denied the tax credits. This brilliantly illustrates how regulatory clarity changes everything. Circular number 231 finally resolved this massive debate by confirming demo cars actually do qualify under the further supply exception, provided dealerships follow 3 incredibly strict phases. Phase 1, the dealer buys the car, capitalizes it, and claims the full input tax credit. Phase 2, the car must be used exclusively for customer test drives. Seriously, if the dealer manager takes it home for the weekend, that credit is totally voided. Phase 3, after a set time, the vehicle must be resold to a consumer at its written-down value, officially completing that crucial further supply requirement.
Let's look at Section 4, taxing warranties and repairs after sales journeys.
What happens when a car breaks down? Let's see how dealerships avoid duplicate taxation when fulfilling warranties in the after-sales phase. Historically, tax authorities would audit a dealership and say, "Hey, you gave this replacement part to the customer for free under warranty. You need to reverse the tax credit you claimed on that part." This caused total chaos. Thankfully, recent circulars clarified that free warranty parts require absolutely zero additional GST and no input tax credit reversal. Why? Because legally, the value of that future free part was already baked into the original sticker price of the new car, where GST was fully paid. Now, automakers can just use simple Rule 55 delivery challenge to move replacement parts to dealers without triggering new taxes.
But extended warranties have a fascinating strategic quirk. If you buy an extended warranty on your new SUV at the exact same time you buy the car, it's considered a composite supply. It gets bundled into the vehicle's price, meaning that warranty is taxed at the vehicle's massive 40% GST rate. But if you wait a week and buy that exact same warranty coverage post-sale or from a third party, it's suddenly classified as a standard service contract, taxed at only 18%. The exact same coverage faces drastically different tax rates simply based on when and from whom it is purchased. So timing is literally everything. If you're buying a new car, you might want to calculate if bundling that warranty is actually costing you a massive tax premium.
Finally, Section 5, the TDS and TCS hierarchy, the financial backend.
Let's see how all this builds into the final and, undoubtedly most complex piece of the puzzle. The invisible direct tax hierarchy that governs the financial back-end of every single transaction. To prevent tax evasion on high-value transactions, the Income Tax Act uses an absolute alphabet soup of tax collected at source, TCS, and tax deducted at source, TDS. Because an auto transaction can technically trigger multiple tax withholding rules all at once, the law establishes a strict priority hierarchy to stop duplicate taxation. Priority Rule 1 dictates that Section 206C 1F overrides Section 194Q. Priority Rule 2 states that Section 194Q overrides Section 206C 1H. Look, if this sounds like a foreign language, don't worry, you're not alone. Let's map exactly what this means in the real world.
So the crucial point is how this plays out across distribution tiers. Look at Tier 2. When a dealer sells a car to a consumer for over 10 lakhs, Priority Rule 1 kicks in. The selling dealer must collect a 1% TCS from the consumer. But then look at Tier 1 and Tier 3. These are huge business-to-business transactions between the factory, the component suppliers, and the dealers. Here, Priority Rule 2 takes over. The purchaser simply deducts a 0.1% TDS on bulk goods over 50 lakhs. Dealerships absolutely must automate these specific tiers into their internal ERP systems because failing to apply the correct section in this hierarchy results in severe non-compliance penalties.
We've seen how meticulously structured this architecture is, from the GST slabs to the exact hierarchy of TDS and TCS. But I want to leave you with this thought. As the EV ecosystem rapidly evolves toward innovations like battery as a service, subscription features, and massive battery swapping networks, can this highly categorized, rigid tax code actually keep pace with the technology? Or are we going to need a completely new playbook in the next 5 years? It's definitely something to watch very closely. Thanks for learning with us on this explainer, and we'll see you next time.